Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hi there, welcome to the COB on this Tuesday, Rates Day. I'm Nadine Blaney, and that takes us right to what we will be covering off with my expert guest who's standing by, Martin Crabb, CIO of Shaw & Partners, the Reserve Bank, lifting rates for the third time this year. The bank deciding to lift rates by 1/4 percentage point to 4.35% by majority decision, 8-1. The RBA says a conflict in the Middle East has resulted in sharply higher fuel and commodity prices, but that is not the sole reason behind this hike. The Governor, Michelle Bullock, being very clear that inflation was a problem prior to the conflict and that inflation is likely to remain above target for some time and that risks remain tilted to the upside. Tom Fenner from Westpac says the rate hike was widely expected, placing it in the context of recent decisions.
Yeah, I think what it might largely be is that it's more of a pickup from what we, some kind of rebound from what we'd been experiencing earlier, because our card tracker data had actually shown that because households were spending a lot more on fuel, both in terms of high prices, but of course also in terms of volume, because they were worried about getting that, they actually then spent more on that and pulled back on discretionary. Now there's maybe perhaps less concern about that, and so we actually had just seen some sort of normalisation between the two.
Stephen Dooley of Convera also joined to unpack the Aussie dollar's immediate reaction to the decision.
The Australian dollar up about 20 points initially after the announcement, so markets clearly seeing that as a sign that there is the potential for further rate hikes to come, so a more hawkish view of that decision, whether that be the case that the board had voted with a greater proportion to hike rates, whether it was the fact that we saw the RBA say they're willing to do whatever it considers necessary to achieve the outcome of price stability and full employment.
But we've got another view from Chief Economist at PwC, Amy Lomas, who gave her assessment in relation to recent geopolitics.
So obviously we know what the petrol price impact is, and that's having a bit of an impact on consumption, but obviously the second-round impacts on inflation and the fact that those are harder to unwind. The petrol situation, a little different. As soon as it comes back, it's a release straight away. It's like having easing. However, when you look at what's going on with the petrol prices staying there for the time being, they're starting to be factored into prices that won't change. It's unlikely if someone lifts their prices now because of petrol, they're going to rush to cut them back. So they probably want to get in front of that and keep expectations down is what
That was David Flanagan from Curve Securities there. So our three themes today, let's take a look. Bitter pill. That's what one economist called this interest rate hike, a bitter pill to swallow for mortgage holders in particular, but demand in the economy still running above capacity. We are also in confession season, of course. The Macquarie conference is on. We've had a number of companies come to the fore, reporting, reaffirming, or warning on guidance. We'll get you across some of them in just a tick. And all of this has resulted in a bit of a tumble for the market. The ASX, though, paring its losses as the Reserve Bank Governor Michelle Bullock addressed the media, saying that rates are restrictive. All right. Quick check in on the sectors of the day. Consumer discretionary stocks. Well, no big surprise to see some pressure coming through here. JB Hi-Fi off by 0.8%. Not showing Universal Stores on that page, but it was one of those presenting at the Macquarie conference. And really, the commentary I read was that it's holding up relatively well, given it's in the retail space. Tech, keeping an eye on tech names. WiseTech Global also presenting at the Macquarie conference, taking a big leg up by 5.7%. Xero Technology One. But Codan for one, and that's been an absolute cracker of a stock, market darling, giving up some ground, down by 8.5%. So really a lot of the consternation, and Amy Lomas from PwC was very clear on the fact that, it's so disappointing to see this flare up around the Strait of Hormuz, of course, because that is driving oil prices. And oil prices are what will not just drive inflation in the fact that you're going and paying a little bit more for petrol, but also the fact that those second round effects, so think fertilizer, think plastics, think all of the things that depend on commodities going through that strait. And in particular, here in Australia, diesel, we're one of the most exposed economies to what's happening in terms of oil. Very quickly, across the news, Westpac has seen a decline in stressed exposures, although it also says the Middle East war is presenting challenges for some customers. Vault Minerals and Regis says they will merge, with Regis acquiring all Vault shares. Ampol expects the ACCC to decide on its proposed EG Australia acquisition by early June. Flight Centre at the Macquarie Conference says its underlying profit guidance for the full year is on track. ALS identified a cybersecurity incident involving unauthorized access to some of its IT systems. Medibank maintaining its FY26 guidance, reporting 25% policyholder growth in the 9 months to March. And Sigma Healthcare is entering the UK market, shares up by 3.5% to $2.94. Very warm welcome to Martin Crabb, CIO at Shaw and Partners. Martin, welcome.
Thanks,
Nadine. A rate hike we had to have, according to the board, voted 8-1 in favour.
Yeah, you called it a hat trick. It feels more like 3 strikes than a hat trick, right?
True.
So, and maybe unlike baseball, maybe there's more strikes to come. So it's interesting to see you used a little bit of this, we're now positioned to wait and see, which was, I don't know, taken by perhaps the currency market to mean they're not going to aggressively hike a lot more from here. The market's still got another rate hike baked in. But if I go back a few weeks, Nadine, I think the view was maybe more than a few more hikes, maybe up to even as high as 5% on the cash rate. So language is interesting. Mixing the two narratives you've got going here, which is the RBA and the second order effects and confession season. We heard from Endeavour Drinks and Sigma Pharmaceuticals, who own Chemist Warehouse, right, about costs in their business. And obviously Endeavour Drinks owns Dan Murphy's and a whole bunch of liquor retailing businesses as well as hotels. And they said there was about $8 or $9 million of more cost in their business from fuel, but they had to carry $400 million more inventory to hedge themselves against supply issues. So they're saying, look, it's okay at the moment, but if we start running low on automotive fuel and we can't get deliveries, we need to make sure we've got lots of stock on hand. So that was not taken well by the market, because obviously they've got to fund that somehow. Conversely, Chemist Warehouse said we're absorbing all the costs. But there's a little bit, obviously moving booze around and moving GLP-1 drugs around are two different things logistically. But it was interesting to see that Chemist Warehouse said nothing to see here. You can see how the market responded to that. Not just that issue, but obviously Chemist Warehouse like-for-like sales up 14%. So it's tough for retailers out there, and it's going to get tougher. There's no doubt about that. But, tale of two cities. Endeavour Drinks really struggling. Sigma Healthcare and Chemist Warehouse doing really well. So that's what the RBA is worried about, is that second order is like, okay, you've warned the Chemist Warehouse of the world, they've warned the higher fuel prices, it's probably impacted them a little bit. They've said, we'll suck it up because the market's telling us it's going to be over in a few months, so let's not bother repricing. And I think more and more people are saying it looks like this thing ain't going away. The poly markets and those sorts of betting markets are showing that the chances of getting stuff through the Straits of Hormuz by the end of July is now only 50-50. And we can see the energy price itself's up 20% the past few weeks. So I think that, so there we go. So here's Keishi, which is like a betting market or a trading market. That's available on the internet if you want to look that up. But you can just see that before August, that was a 90% chance back in April. It's now a 45% chance right now. So businesses have got to be looking at this. And we spoke to some of our clients last night at a dinner and said, look, you've really got to start looking at your fuel costs now. You probably didn't have to, and you probably didn't have to worry about it, but it now looks like, we are going to have some problems. And from an inflation perspective, that's terrible news, because if we do start to get shortages, then Nadine, you and I will be going down filling up our F100s with petrol, right? So if that starts happening, we're going to see even more inflation, and that's what the Reserve Bank's worried about. So sorry to continue that narrative on energy. The price of oil's gone up, but oil stocks have come down. So over that same time frame, the Brent crude price is up 20%, but Santos is flat and Woodside's down 5%. So to us, it's like the cost of insurance is actually falling. So the cost of insurance for your portfolio is add some of these stocks to your portfolio, because if it kicks on and the oil price stays high, those stocks are going to get upgraded quite strongly. So Viva Energy, Ampol, Santos and Woodside. So at Shaw and Partners, we've been adding Santos to our large cap portfolio because, as I said, we think the risk of something going wrong here is going up, but the price to insure it is coming down. For us, that's a great bet.
Okay, so Santos is what you're allocating to, Woodside, Viva. When you think about some of the commentary coming from companies, and of course Michelle Bullock, the governor of the RBA, is very, very focused on inflation expectations, rightfully so.
Yeah.
As investors, do we need to be careful as well that they're not companies that are using this as cover for other sort of sins, so to speak?
Yeah, it's like AI washing. Like, I really want to sack 1,000 people and I just use AI as the reason to do it. I think there might be a bit of that. I think the real, and this is interesting, having the confession season conferences on at the same time as this, is people are asking management, so what's happening? Obviously, your costs have gone up and they're probably going to go up more. Are you passing it on to customers? And the other issue from an investment perspective is, can they pass it on? It's this concept of pricing power. So if I'm running a monopoly, like say a toll road, you either drive on my road or you don't drive on my road. So it's a monopoly, right? Or something like the Australian Securities Exchange is kind of monopoly. So those businesses can pass on higher costs because they have what's called pricing power. Maybe Telstra has it. Maybe some of the supermarkets have it. Who knows? The banks certainly have it, pricing power. So they can generally pass on higher costs to their customers. Weaker businesses that are in very competitive industries, think of like developers, building materials, these sorts of industries where there's lots of players and it's a race to the bottom. Those industries really, really suffer in an inflationary environment. So it's not just looking at, okay, is it happening? It's, can you do anything about it if it does happen? Like if all of a sudden your costs are going through the roof and you go to your customers and say, excuse me, I'd like to help you pay for some of this, and they go, I'm sorry, we're not going to do that, we'll go to your competitor, then that's a big issue. So it separates the weak from the strong, this kind of environment.
Now today, the market down by about 0.5%. It was down around that amount before we went into this decision.
Yeah.
And that's just proof, I suppose, that it's largely been priced in. We were expecting this rate cut.
Yeah.
I know you don't have a crystal ball, but what happens from here? Because we're seeing the Australian market underperform what we're seeing overseas, largely because of the AI investment story.
Yeah.
Does this market become less and less and less attractive for foreign investors, which again will impact us at least at the index level?
Yeah, I think so. It depends what the foreign investors are looking to buy when they buy Australia, because 25% of our market is mining. So there's some investors going, look, there's this commodity price inflation out there. I'll allocate some to Australia, some to Canada, some to South Africa, wherever, some to Chile and Brazil, because those markets are commodity markets. So they might just look at us for that. If we dissect the Aussie market, we know that there's a quarter of bankers, a quarter miners, and then the other half is probably where people should be worried. So the banks, maybe not now, but maybe down the road, I think bad and doubtful debts will start to be an issue for people. Not really at the moment, although the banks have all raised their provisioning. But I think for domestic investors, it's like global markets are starting to look more attractive on a relative basis to what you can get here. Will it impact foreign flows? A deteriorating domestic economy may just keep people a bit cautious. Like, I don't think people have been looking to invest in Australia on the domestic economy side because it's really not that exciting, the outlook. But certainly on the mining side, we'll continue to attract inflow into that sector. So we may actually see net buying of the country, but it may not be across the board. It may be a little bit more selective. But from our perspective, we've moved underweight Aussie equities and overweight global equities. In fact, we moved 3% of the portfolio last week because we can just see this situation potentially getting worse in Australia. It's clear from Governor Bullock today that they're not done yet. There's more to go. So there's a bit more pain out there for the average punters, unfortunately. But from an investment perspective, that means that global markets by default look more attractive than domestic markets do.
Our panel earlier on said crappy. It's going to feel crappy out there for a lot of people. So when you are talking about allocating overseas, is that a US story primarily? We had somebody in last week talking about Japan still looking really attractive. Europe seems to be less attractive.
The valuations look great in Europe, but the outlook's pretty horrible, and they've still got a lot of issues with their demographics and their social policies, and just trying to get a cohesive kind of approach to things. The US is flying. We're looking at $1 trillion of hyperscaler capex. So it's 3% of GDP just by 5 companies building data centers. It's incredible, right? And their consumer is holding up incredibly well. They've got the same inflation issues as we do. Gasoline prices, $5 a gallon or whatever it is, maybe $6 in some states. So they're feeling the squeeze same as us, but their high net worths are spending like a drunken sailor, if I can use that term. So high net worth spending and AI capex is absolutely driving that economy, and those things aren't going to go away. Whereas in Australia, it's like things are going to get tougher. It's going to get tough out there in retail. The housing market's starting, house prices are coming down, not going up. We've already seen housing housing approvals come down, the data yesterday. So I think things get a lot tougher here. So you kind of go, right, I'm going to go where there's some growth, and that's clearly the US market. It's still 70% of the world market. So when you go global, you're going US anyway. But I do think you're right on Japan. I think that continues to look really attractive, as does Korea, as does Taiwan, particularly if this Strait of Hormuz thing resolves itself. Those countries are going to do really, really well.
We will see. Nobody knows. Martin Crabb, CIO, Shawn Partners. Nice of you to come in.
Thank you.
We always catch up on rates day, and I appreciate it very much. All right, stock of the day, Sigma Healthcare. We spoke with Sean Hickman from Market Matters and Rudy Philippek Van Dyke from FN Arena. Here's what they had to say.
Like it, I'm a shareholder. I'm a shareholder for a very particular reason. I just mentioned that investors probably have to keep an eye out now for which businesses are more resilient than others. I think, I was never a big fan of Sigma prior to the reverse takeover by Chemist Warehouse. I think Chemist Warehouse, coming of Chemist Warehouse into the share market is a blessing for investors. I think you get the chance now to own a very high quality company, very resilient.
They came out with a update in, I think it was October, when they said the synergies were going to be improved from 60 million to 100 million. These guys are doing it right. They're doing everything right. The move into the UK makes sense. The stock popped over 3% today, etc., etc. Top quality business. But, got to have a but. First stock, it's already trading on 44 times. This is a stock that's priced, I won't be as naive as to say perfection, but it is priced for good news. And if you go back, perfect chart, it hasn't moved anywhere for 18 months yet. It's had good news over that time frame.
You've worked hard for your money all your life. Now your money needs to work hard for you. Whether you're building, transferring, or drawing down, the right information makes all the difference. At Ausbiz Retire, you'll find the latest news and insights from trusted experts all in one place. Ausbiz Retire is powered by RAN, retirement income done differently.
All right, so what led this market higher today in percentage terms? I can tell you Capricorn Metals up by close to 11%. Ventia Services put on about 6%. Macquarie becoming a substantial holder. WiseTech Global also, we did see it coming out saying that it expects underlying earnings to come in between 598.5 to 637.5. Earnings margin between 40 and 41%. So really impressing in its share price. Turned out to rise close to 6%. Pinnacle as well, presenting at the Macquarie Conference, up by 5%, and Flight Centre up by 4.6%, saying that the Middle East crisis has hit leisure profit in April, but not seeing a large impact on its corporate business. And also saying that it will see underlying pre-tax profit up by 19% to $102.6 million in the third quarter. So remarkably, we're still flying. I mean, fuel shortages and the like, and Sigma as well. Our stock of the day was one of the best performers. On the flip side, though, Codan did come out. It is down by 8.5%. Look, I guess a lot of folks thinking that the markets, that Codan is fairly valued, if not overvalued, so taking a bit of profits as well. Magellan Financial Group will no longer be charging performance fees because it has shifted its global equities funds management to Vinva Investment Management, so managing funds with $5.3 billion of assets under management. So real changes happening at the core of Magellan there, especially when you take the Bear and Joey move into consideration. And Regis is on there looking to merge with Volt, buying all of Volt shares. In the small to mid-cap space, look, Addison did have an announcement out today. I can't say that I spent a lot of time reading it, only because we were so preoccupied with everything else coming out. Up by 10% though, so good on Addison, to 22 cents per share. Wish I could add more value there for you. Look, some of those that did lag the market overall, Ecograph, Demerix, Hot Chili, G8 Education, and Horizon Gold. So what's happening tonight? We are still in first quarter earnings season. AMD, PayPal, Shopify, and Pfizer. We get the ISM Services PMI, which is expected to edge down in the US, and we get that JOLTS job openings read. So who's quitting? Who's confident enough to quit their jobs right now? That'll be an interesting one to read tomorrow. Okay, tomorrow we have the Rio Tinto AGM. We also get quarterly updates coming from the likes of Amcor and Light and Wonder. Of course, both have overseas operations. Okay, so just to round it out, we saw the CBO Australia Index initially pull back at 230. You can see that clearly on the screen. But then we started to see a bit of a resurgence in sentiment. As the governor said, that the way that rates are set right now, so after those 3 hikes, that it is in restrictive territory and that it is been set, the monetary policy has been set to address inflation that was a concern before the Strait of Hormuz. Obviously, the oil shock is accentuating the inflation problem, will have long-lasting impacts, unknown what the secondary impacts of that will be, but giving the market a little bit of cold comfort that that there is the potential to see this latest rate hike have an impact on inflationary expectations going forward. So look, folks I was speaking to today still expecting another hike to come through, possibly as soon as next month. All we can do is wait and see how things evolve. But look, thank you for being with us today. I do wish you well. I don't think for anyone it's good news to hear that the Australian economy is going to go through a little bit of a tough time, but we'll keep you across everything you need to know in relation to your investments. Keep us tuned in, catch up with what you may have missed. We'll see you tomorrow morning.